Today we're digging into the Q3 earnings for MindWalk Holdings, ticker HYFT. And let me tell you, this report is a classic Wall Street tug-of-war. On one side, you have some pretty ugly numbers, and on the other, you've got management painting a picture of a massive, bright future. So, which one do you believe? Let's get into it.
So here's the entire dilemma in a nutshell, right? They missed on revenue, they posted a huge loss, but then, in the very same breath, they announced a massive new partnership that they claim changes everything. So, what's the real story here? The messy present or the promising future?
Okay, first things first. Let's break down the raw numbers. This is the part of the report that, well, it kind of spooked the market right out of the gate.
Let's start at the top line. Revenue came in at 6.2 million Canadian dollars, which was about $450,000 shy of what analysts were expecting. Now, you might think that's not a huge miss, but in a really tough market for biotech companies, any slip-up on revenue, it immediately puts you on the defensive.
Now for the bottom line. And this is where it gets, a little complicated. The big, scary headline number was a GAAP net loss of $21.5 million. I mean, wow. But hold on. If you look closer, pretty much all of that, $21.2 million to be exact, was a one-time, non-cash impairment charge. So management's story was, hey, ignore that, focus on this other number, our core non-GAAP loss of just $2.9 million. They're arguing that's the real pulse of the business. And right there, that's our first major clash between the official numbers and the narrative.
So, with those pretty challenging numbers as the backdrop, let's flip the coin. Let's talk about the story management really wants investors to hear. Because they're not just trying to explain away a bad quarter, they are pitching a whole new direction for the company.
And boom, here it is. This is the centerpiece of their entire argument. On the very same call, they dropped news of a new strategic partnership worth between 8 and 10 million US dollars. Now, to put that into perspective, they just reported 6.2 million Canadian for an entire quarter. A deal this big isn't just a nice win, it's a potential game changer.
Now, the really crucial point here is how they're framing this. Management isn't just saying, hey, we got a big contract. They're calling it a template. The whole argument is that they can do this again and again and again. The idea is to shift the entire business away from this choppy, project-by-project work and into these big, predictable, long-term contracts.
And this slide really sums up their new identity. See, they want to stop being seen as just another biotech services company. They want you to think of them as a tech bio platform. The core concept is simple. Use their unique AI technology as a hook to land these massive multi-program deals that bring in much better, higher margin and, more predictable revenue.
So, you've got the bad numbers on one hand and this incredible growth story on the other. So which one did the market believe? Let's take a look at the immediate reaction. Well, the verdict was pretty clear and it came fast. On the day of the earnings call, the stock dropped almost 4.4%. So, at least initially, the market was way more worried about the revenue miss and that big GAAP loss than it was excited about the new vision.
This slide just captures that disconnect perfectly. On one side, you have management talking all about momentum, this new scalable model, high-margin AI, but what the street heard was revenue miss, ugly headline loss, and they started asking that big question. Can they actually pull this off? It's a classic credibility gap. So what has to happen for that credibility gap to actually close? What are the key things that we as investors should be watching for on the horizon? Think of this as their to-do list for winning back Wall Street's trust. First, they've got to deliver on this new deal. That's table stakes. Second, and this is the big one, they have to land another template deal to prove this whole model isn't just a one-hit wonder. Third, selling off their EU lab would really simplify the story and bring in some cash. And finally, they have to show that this AI revenue can actually grow and become a real, meaningful part of the business. All right, let's put it all together. Here is our take on MindWalk as we start looking ahead to their next earnings call. This is the fundamental question for the stock right now. Over the next couple of quarters, are the numbers finally going to catch up to this exciting story, or is the story going to come crashing back down to reality? So our prediction for next quarter? Well, we expect to see the new deal start contributing to revenue, but the overall headline numbers are probably still going to look a little messy. Because of that, the stock is likely going to trade sideways, just kind of stuck in a range, until there's proof of a second major deal. And this means the most important metric to watch has completely changed. It's not just about quarterly revenue anymore. It's about new partnership bookings. That's the real signal now. And that brings us to our rating, Market Perform. Look, the growth story here is really compelling. This new deal template could genuinely transform the company, but the execution risk is very, very high, and the market needs to see proof. So until they sign another major partnership, the risk and the reward feel pretty evenly balanced, which calls for a neutral kind of wait-and-see approach.
And as always, please remember, this is not financial advice.